Hey there, welcome back to the channel. If you're new here, I'm Shanice Thorne, and today we're talking about something every real estate investor should know: real estate investing mistakes to avoid and how to win. Real estate investing can be one of the best ways to build long-term wealth, but it's not without its pitfalls. I mean, you've heard the horror stories, right? People losing their shirts, getting stuck with properties they can't sell. It's enough to make anyone think twice. But don't worry, I'm here to tell you that it doesn't have to be that way. Today, I'm going to walk you through some common mistakes that both beginners and experienced investors make, and how you can avoid them to make sure you're on the path to success. Let's get into it. All right, let's kick things off with mistake number 1, not doing enough research. One of the biggest mistakes new investors make is diving into deals without thoroughly researching the market, the neighborhood, or the property itself. You need to understand local real estate trends, demand for rentals, expected appreciation, and the property's true value. What are other comparable properties renting and selling for? What kind of expenses can you expect? Is the neighborhood improving or declining? These are crucial questions. Trust me, a little research upfront can save you a whole lot of headaches and money down the line. Remember, knowledge is power, especially in real estate investing. So do your homework and you'll be one step ahead of the game. Next, let's talk about mistake number 2, overleveraging yourself. Leverage is a powerful tool in real estate, allowing you to buy more properties with less money down, but it can be dangerous if misused. Overleveraging is when you take on too much debt relative to the value of your properties or your income. Imagine buying a rental property with a small down payment and a large mortgage. If the market takes a downturn, rents drop, and your tenant can't pay, you're stuck making huge mortgage payments out of your own pocket. To avoid this, be conservative with your leverage. Don't stretch yourself too thin just to get into a deal. Make sure you have a comfortable cushion in your budget to cover expenses, even if things don't go according to plan. Remember, slow and steady wins the race in real estate investing. Moving on to mistake number 3, ignoring cash flow. Many new investors get caught up in the idea of property appreciation, thinking that's where the real money is made. Cash flow, on the other hand, is what pays the bills today. It's the difference between the income your property generates and the expenses it incurs. If your property isn't generating enough income to cover expenses, you're setting yourself up for financial strain. So how do you ensure positive cash flow? It starts with buying the right property in the right location. Look for properties in areas with strong rental demand and affordable prices. Be realistic about your expenses. Remember, cash flow is king in real estate investing. Focus on building a portfolio of properties that generate consistent positive cash flow. Here's another big one. Mistake number 4, skipping inspections. Never, ever skip a property inspection. It might seem like a small cost at first, but it's a drop in the bucket compared to the potential costs of uncovering major issues later on. We're talking about things like foundation problems, plumbing leaks, electrical hazards, roof damage, mold. You name it, a good inspector can find it. A thorough inspection is your best defense against costly surprises. It gives you a clear picture of the property's condition and allows you to make an informed decision. If the inspection report comes back clean, great. But if it uncovers major issues, you have options. Walk away, renegotiate the price, or ask the seller to fix the issues before closing. Skipping it is like playing Russian roulette with your investment. Don't do it. Next up is mistake number 5, not having a clear exit strategy. Every real estate investment should come with a plan for what happens when things don't go as expected. Think of it like a backup plan for your investment. What will you do if the market takes a downturn? What if you're unable to find tenants? What if you need to sell the property quickly? Having a clear exit strategy in place before you even buy the property can help you make rational decisions in the face of unexpected challenges. It also helps you to define your investment goals and measure your success. Are you planning to flip the property for a quick profit or hold it long-term for rental income and appreciation? Having a well-defined exit strategy in place can help you navigate challenges and come out on top. Here's a huge one. Mistake number 6, failing to account for property management. Many new investors underestimate the time, effort, and costs associated with managing a rental property. Being a landlord can be time-consuming and stressful, especially if you're dealing with difficult tenants, late-night repair calls, and maintenance issues. Decide early on whether you'll be managing the property yourself or hiring a property management company. Managing it yourself can save you money on fees, but requires a significant time commitment and a certain set of skills. Hiring a property management company can free up your time and alleviate stress, but comes at a cost. Choose the option that best fits your personality, time commitment, and budget. Now let's talk about mistake number 7, not diversifying your investments. It's tempting to put all your money into one property or one type of property, especially when you're just starting out. But just like any other investment, real estate needs diversification. Putting all your eggs in one basket exposes you to a lot of risk. Diversification is about spreading your risk across different property types, locations, and even asset classes. Start by diversifying within your local market. Consider investing in a mix of single-family homes, duplexes, triplexes, or even small apartment buildings. As you gain more experience and capital, you can explore other markets or asset classes like commercial real estate or REITs. By diversifying your investments, you'll be better protected from market fluctuations and unforeseen events. Okay, so now that we've covered the mistakes, let's quickly go over how you can win in real estate investing. Remember, it all comes down to making smart, informed decisions and avoiding common pitfalls that can trip up even the most seasoned investors. By avoiding these common mistakes and following these tips, you'll be on the path to becoming a successful real estate investor. Thanks for watching, everyone. If you found this video helpful, give it a thumbs up, subscribe for more real estate tips, and drop a comment below letting me know which mistake you've seen others make, or maybe even made yourself. Let's keep the conversation going. Until next time, happy investing.